I think you've all been waiting for this one. It's all about scalping. Okay. This is a big topic. It's a really big topic. It's probably a topic that's going to lead us to run over time tonight, but we need to go through it. And I want to really kind of break down scalping, give you a good understanding of what scalping is and isn't, talk about the pros, cons, make sure that you understand different scalping strategies. And then talk a little bit about risk management and why it's so important in particular for scalping. Now, this topic comes about, a Tradelo member came to me with a big question. I'm going to read the question for you, and then we'll get stuck into this topic. And what he said to me this trade, he said, do you have any tips or perhaps a video about scalping? I've been sim testing and I typically end up break even or slightly ahead. That's much better than I used to be, but feel a bit stuck. My current setup is a 6-tick bracket with a 7-tick reversal, and I usually use limits at the bid or ask, but when there's strong momentum, I might mark it in. Okay, I'll also tend to scratch if the trade doesn't hit the target quickly or it seems it's just rotating through the entry. Now, why I like this message is because I think it's so relevant for so many traders that choose to scalp as their initial strategy. Okay, and that's why we're going to go through this topic quite extensively tonight. Now, like I said, scalping is a big topic. So let's start by outlining what scalping is. Okay, there's a little bit of a misconception here, so listen very carefully. Scalping is a type of strategy. It's not a style of trading. I think there's a misconception that, I'm a scalper and by definition, I take small winners and small risk. Okay, that's not what scalping is. Scalping is a strategy, and there's a time and a place to adopt the strategy, and we'll talk a little bit about that later on. Okay, the same as a breakout momentum is a strategy. The same as volatility mean reversion is a strategy. They're all different strategies. They all get applied in different contexts. They all have pros and cons, and they all present different opportunities to us. And we need to apply them accordingly. Now, scalping is not a trade style. Like I said, it's a trade strategy that involves making numerous small trades with the goal of profiting from small price movements within a very short time frame. Okay, often some seconds or minutes. Now, while scalping can offer certain advantages, it does come with a significant list of challenges. Okay, and we're going to get into that quite extensively today because I need you to understand the trade-offs. Right, it's not to say that you should or shouldn't choose scalping. It's to say that there's a time and a place to scalp, and you need to be aware of how scalping will hold you back, but equally how scalping can also make you move forward. Okay, now I want to summarize today's topic on scalping with a conclusion. So I'm going to start with a conclusion, then you'll understand exactly what we're going to talk about. As I said, scalping is a trading strategy. It shouldn't be your primary strategy. By primary, I mean it shouldn't be where you make the bulk of your revenue because it typically has low real risk reward. And to get this risk reward and be profitable, it requires you to do a significant amount of round trips. Okay. If your primary strategy is scalping, your broker will be very happy, but your account growth will be slow. Moreover, it takes a lot longer to size up on scalping strategies because ultimately at some point available liquidity will become an issue and it will cap how big you can become with scalping. Okay, scalping is of course a profitable strategy to adopt, no doubt. I will show you two very profitable strategies later on. It is a very profitable strategy to adopt so long as you can execute it methodically and capture the data necessary to develop the strategic or the strategy optimally. That's the key. If you want to be a scalper, number one, you have to accept that there are limitations to it as a strategy. You can make good money, but there are limitations. But equally, in order to progress with it and make good money, you're going to have to start capturing that data, and you're going to have to learn how to manage your risk optimally. Otherwise, your strategy is going to be just like this trader explained, where your account size is just going to go sideways. Okay, the only person that's going to win is the broker. Now, I scalp a lot, but this isn't where I make the bulk of my account growth. My money is made from big time frame breakouts, from macro event trading, from structural breaks. That's where I make the bulk of my money. Liquidity blocks, okay? I will scalp in very specific market conditions, and I have a number of different scalp strategies. Tonight, I'll show you two of them, okay? Scalping is not my primary income source, and I do sometimes joke that I will scalp trades simply just to pay for my license fees, pay for my data fees, pay for my subscriptions, okay? That's sometimes how I think about my scalp trades. It pays my monthly expenses, okay? The point is, scalping is something intentional. I choose to scalp. I come in, I look at the market, I say, today I'm going to scalp this market, simply because there is no contextual opportunities for me to take part in, okay? So when relative volumes and liquidity is very light, what I typically do is I shift my mindset into scalping mode. Today I'm going to scalp, and I'm specifically looking for specific scalp strategies. All unique, and all have their own exit and entry methodology. Now, before I take you through the two strategies, let's discuss some of the good and the bad of scalping, the pros and the cons. Okay. Firstly, obviously, scalping allows traders to capture small price movements in real time within very small time frames. We're all aware of how nice that feels. Okay. It feels like we're not having to take much risk and we can make good money quite quickly and easily. Okay. Scalping as a strategy presents a lot of opportunities. There's a good frequency. Okay. This provides ample opportunities to capitalize on short-term price fluctuations, but also if we do have little drawdowns, we can make those losses back quite quickly because the trade opportunity is frequently occurring. All right. We also have a lot less market exposure, right? Because we're only in for a couple of seconds or a couple of minutes. Effectively, we don't have much exposure to significantly volatile moves in the market. Okay. We also don't have to hold overnight positions, which means we only have to post so much margin in our trading accounts. Given scalping strategy has a high frequency, even when you go on a bad run, the drawdown period is quite limited. Okay, so you can make back those losses quite quickly. And then finally, given you are typically scalping when markets are doing little, in other words, you scalp in a specific context or environment, it gives you a little bit of diversification. Okay, so when your market's in play or there's flows, you make the money from that. When your market's dead, you make your money from scalping. Okay, so it gives you nice diversification. Equally, like I said, your contextual trades will occur a lot less frequently. So when they do occur, obviously you want to capitalize on them. But when they're not occurring, you can also then make money as a scalper. Okay, so those are the pros. There's a lot of good reasons why we would want to scalp a market. However, there are also some really downside reasons why that you need to be aware of. Okay, firstly, like I said, and the most important one, scalping involves a lot of buying and selling. Okay, and this results in higher transaction fees, brokerage fees, spreads. Okay, these costs eat into your profits. There's no ways to get around it effectively. You're going to have to pay your broker. And if you're scalping a lot, most of your upside is going to the brokerage. Okay. This is why I'm very against recommending, particularly for new traders, starting with a scalping strategy. It's not the right strategy to start with. It is a strategy you can adopt later on in your career. Okay. With scalping, obviously, fills matter a lot. Trust me on this. It's something that irritates me quite extensively. Where you enter and exit, ultimately, you have to be precise. And often with scalping, the difference between winning and losing on a day on your scalp trades comes down to a full or a not full. Okay. Moreover, position sizing is limited to how much the market can take. If you've ever tried putting a 20 lot in the gold market, you will find out very quickly that the market cannot take a 20 lot. Sometimes it can't even take a 5 lot. All right. What this means is that if you can't get filled, your upside profit is limited. Okay. And equally, the only way you can make more money is by doing more turnover. Okay. Also note, as a side note, nowadays with level 3 data, unfortunately, institutional players can see inside the order books. Okay. So again, if you're using 20 lots, that's very often why you don't get filled. Okay. Because the algorithms are not going to come and give you that fill. And again, if you don't get filled, that's the difference between winning and losing on scalping. Okay. Scalping also encourages frequent trading. Okay, it goes without saying, when you're scalping, you're going to be over trading. Okay, you're going to enter into trades very excessively or impulsively. And we all know what that means. It means more round trips. It also means we're exposing ourselves potentially to losses. Okay, now, while scalping can offer the opportunity for quick profits, each individual trade typically generates small gains. Okay, as a result, traders need to execute a large number of trades to achieve significant overall profit. And guess what? This is very time consuming. All right. It means you've got to sit at your desk 10, 11 hours a day. And it's also very stressful. And then finally, like I said, emotional stress. The fast-paced nature of scalping can be emotionally demanding, and it's very psychologically stressful. Okay. You get burnt out very quickly when you're scalping versus, sitting on a trade and kind of putting your stop and putting your target in. Okay. They're two very different focus-oriented approaches. And one does run you down a hell of a lot quicker. Okay. So those are the cons. And again, it's not about don't scalp. It's just about there's a time and a place to scalp, and you need to know when to scalp. You need to know how to scalp, and you need to, most of all, know how to manage your risk with scalping. That's the key to scalping, and we'll talk a little bit about that in a moment. Now, we're going to talk about two strategies, okay? And in fact, before we get to that, I just want to say one more thing. Scalping can be profitable for skilled and disciplined traders, okay? But like I said, it does require very careful risk management, very strong psychological resilience, and the ability to execute trades quickly and efficiently, okay? You must carefully weigh the pros and cons. And like I said, and I'm going to stress this again, for new traders, steer clear of this being your starting strategy. Okay, I recommend you focus on flow-driven strategies. First off, why? because flow-driven strategies by definition have got a better risk-reward profile, typically 2-to-1, 3-to-1 type real risk-reward. Okay, they don't occur as frequently, but typically you can keep very tight stops. So what it allows you to do is take a lot of them, experience a lot of them, not lose too much money, and every now and again, when you do get one right, you make your money back quite quickly. Okay, so if you want to adopt scalping, it shouldn't be your first strategy. It should be something you adopt a little bit later on. Now, let's go through the two strategies. The first one is a strategy we call the double D scalp. But before I explain this to you, the most important thing to understand about scalping, okay, and this is why I said it's something that when I come in every single day, it's a decision. It's a premeditative decision that I'm taking that today I'm going to scalp the E-mini S&P 500, okay? And it's premeditative based on ultimately what is the market ultimately doing at that point in time, okay? I will never scalp a market that's breaking out, okay? If a market is, moved into sort of record territory, or, it's sort of breaking out and we got one-time framing and really high volumes, I'll never be scalping that market. Why? Because the market's offering me other plays that I want to be partaking in. So I don't want to be in scalp mode. I don't want to be in that mental mindset of, I want to take 5 ticks or 10 ticks. No, I want to be looking for those bigger moves, for that 30, 40 handle move, for those profile type moves, for those, high to low kind of moves. So it's very important to understand that you scalp when the context suggests it's right to scalp. Okay. Now, if you want to develop your own context, I can give you a very basic metric you can use. Okay, on your daily charts, go put a 20 MA. Okay, so just a 20 day moving average. Okay, and then go and combine with it the volume. Now, when the moving average is moving sideways, and when the volumes are about average or below average, at that point, that's a very good context in which you want to be scalping. Okay, because in essence, if the moving average is moving sideways, it means the market's moving sideways, which means there's not a great deal going on, which makes scalping a really good strategy to adopt. Okay, and it doesn't matter what scalping strategy you're adopting. Typically in sideways markets, you will find scalping a lot easier. When ultimately that moving average starts to move up or down, or the volumes are quite high, that's when you have to be a little bit more careful scalping the markets, because that's when you're going to get those bigger volatile moves. Okay, and again, that's one way to do it. The important thing is you've got to develop your own contextual understanding of when you want to be in scalp mode and when you don't want to be in scalp mode. Okay, now the first strategy we're going to talk about is the double distribution scalp. Okay, you all should know what a double distribution is. It's a profiling concept, but ultimately I do this on the footprint. I'll show it to you in a minute. Well, what I'm looking for is on a 15-minute or a 30-minute footprint. Okay? It doesn't matter which one you use. You can observe it on both. What you want to do is wait for that candle to close. Okay? So wait for the 15-minute to close. And what you'll have is two distinct areas where volume is transacted. And you will have what we call an LVA, or a low volume area, or an imbalance. Okay? In footprint terminology, we call it an imbalance of volume, where we've traded a lot of volume here, we've traded a lot of volume here, and we've traded very little volume in the middle. Okay? Now, when you see this sort of 15-minute candle or 30-minute candle, and we are in the context of scalping mode, in other words, the market's not doing anything, okay? Ultimately, we want to be looking to allow that market to come into this LVA and then trade the LVA out. In other words, what we're looking the market to do, or what we're expecting the market to do, is fill out this low volume area, okay? Now, what's very important here is you don't presume, you don't assume it's going to fill it out. What you do is, if we assume this is moving to the downside and we've closed down below, if the market comes back up above the midpoint of this previous candle and begins the process of trading out the low volume area, we are then looking to be executing around that VWAP. Okay, so what we're looking to do is get involved where the average price is traded within that candle, and we're then looking for the market to just fill out that low variance, and we're going to scalp it. We are literally going to sit there and go, I'm going to short it there, I'm going to buy it back there, I'm going to buy it back there, and I'm going to sell it there. And we're going to trade within a very narrow range of prices. Okay, and you can do this a couple of times. And again, how you scalp it is up to you. Obviously, the first scalp is going to be a lot better than the subsequent scalps, because once it's filled this out, the market will then move and continue doing whatever it needs to do. Okay, so that's the general idea of this. Now, like I said, the entry is around the VWAP, okay, but we need to wait for that market to come back above the 50%, because that ensures we avoid suddenly randomly fading a move that's actually trending. Okay, equally, we want to get out and exit the trade once the market tests in at that lower bound of volume. Okay, and I'll show you an example of this in a minute. And then in terms of stop, well, we don't really want to see the market trading above the high volume area above. And effectively, once the market starts to accept volume there, we'd rather exit the trade and take our loss. Okay, in terms of a risk reward, you're looking somewhere around 1.25. Okay, so that's, in my experience, having done this trade a number of times, okay, the actual risk reward you're going to generate out of this is around 1.25 times, okay, but it's got a very high frequency, it occurs quite often, and it's quite a fun trade. It's got a pretty good win rate. You can go and observe it in the markets for yourself. Okay, so this is what it looks like. Okay, you can see obviously this is the German bunds. We've got a little bit of volatility in the market. Market crops up. Okay, there's our first little distribution, and down below we've got our second little distribution, and the market's just left a very much an untraded area in between, a low volume area. Okay, market then comes back up above the midpoint. Okay, we trade above the midpoint, we test the VWAP, and ultimately the market trades 28 contracts in and around that VWAP, as well as another 1,000 contracts around that VWAP, and it begins the process of filling out. And that's what we want to look for. Okay, we're looking for volume to trade within that low volume area. That is the area and the zone within which we want to be scalping. Okay, we want to look to sell around the VWAP and target in and around that previous volume area, and then trade it out. Look to buy it, look to sell it, and we want to make sure that the market doesn't get back above that previous high volume node. Okay, that's in essence where we'll be stopping out. That's where we do not want to see the market suddenly churning a lot of volume. If it starts to churn a lot of volume above that previous high volume node, you've got to be very careful and you've got to exit the trade. Okay, and you can see in terms of risk reward, if I just illustrate that for you. Okay, in terms of our reward, we're kind of looking at, in this example, probably around 8, 9, 10 ticks. And in terms of stop, okay, you can see we're looking at around 5, 6 ticks. Okay, that's that 1.25 that I was talking about. And again, how many times you scalp this out? What I would typically do is always sell it, always buy it the first time. When I'm buying it the first time, I'm looking for a much smaller bounce. Okay, so again, as you trade it more and more, when you sell it the second time, typically my targets will become even less, my stops will become even tighter. And again, how many times you trade it is up to you. But what the market's looking to do is it's looking to fill out and trade volume within this low volume area. Okay, that's your first example called the double D, or the double distribution scalp. Okay, now the second one is extreme volume delta, and this is something that you see quite a lot in the opens of a lot of the cash markets, where one big order comes to the market. The way to think about this is you've got one order, it comes to market, it's trying to get filled, it's taking all the available liquidity. It's a high amount of volume and a high amount of delta. So there's a very strong directional, sort of extreme amount of selling or an extreme amount of buying in the market. Okay, and they're looking for that liquidity. Now, what typically happens, again, we're going to use the 15-minute or the 30-minute time frame for this, again on the footprint. And ultimately, what we're looking for is we only want to take this trade within the previous day's range. Okay, so if we're outside of the previous day's range, we're not interested in this. Why? Because if suddenly we see price directional bias, high volume, and directional moves once we're outside of the previous day's range, it's probably more likely to be momentum. Okay, so if we're inside the previous day's range and you see a very aggressive order, very high volume, okay, and very high delta, so high volume, high delta, very directional, what we're looking for is an extension in the next candle of that previous candle. It's almost like that first candle, it's one order, and one order doesn't get filled in 15 or 30 minutes. Very typically, there'll be some sort of a continuation or extension in the next candle. Okay, so when we see that, what we're looking for is we're looking for, again, some sort of a VWAP entry, right? We're looking for a VWAP entry to then again target a little bit of an extension and ultimately a very, very nice tight stop. Okay, I'll show you two examples in a minute. Like I said, in terms of the real risk reward for this one, it's a little bit higher. It's around 1.6. Okay, so you'll get a very decent risk reward on this. You can keep a much tighter stop. Why? Well, because of the nature of the initial sell. Okay, so as that big order comes to market, they're not exactly going to allow the market to have a very deep pullback. What that means is we can use a little bit of a tighter stop with the strategy. And again, we have a very good predetermined target. This is that one strategy where the target is predefined. Okay, we're looking for a retest of the low. So we know what the target is prior to taking the trade strategy. Okay, now very, very important with this trade strategy and all scalping in general. This is very key to scalping. Keep in mind that because we only have very tight stops and very small targets, every tick matters. Okay, and this is something that, when I was working with this trader on his scalp strategy, one of the keys to being successful as a scalper is you've got to always be looking for, how can I improve my entry by just one price? Or how can I tighten my stop by just one price? Because if you get a one tick better entry, okay, if I illustrate this for you, let's say we get a one tick better entry where we can enter over here. What that in essence means is that our stop is one tick less. And what that means is our target is one tick more. So we're gaining 2 additional ticks. Now in a strategy where we typically only get 6 ticks, now we're getting 8 ticks. That's a 25% optimization simply because we improved our entry by one price. And that's crucial to understand. If you're a scalper, you've got to become fixated on where you're entering and where you're placing that stop, because that is ultimately how you optimize a scalping strategy. Okay. Yes, the targets with scalping can be very much predetermined, and they need to be predetermined to determine if you've got any edge. But ultimately, that's where we kind of work, our ass off. We very much focus on how can we improve our stops? How can we get in at better prices? You focus on that and you'll start to see some really significant gains. Now, in terms of what it looks like, okay, 2 opportunities here. Both are in the German Bund. I think one was today, one was yesterday. And what you can see is we get a very strong price directional move. Like I said, within the previous day's range, very high volume, highest delta on the day. Okay, so extreme directional move. You can see it's a very intentional move. It's an order coming to the market. We get that pullback into the VWAP, okay, and the market trades out 2,000 contracts into VWAP, extends the high. Okay, and like I said to you, we can keep a very nice tight stop on this. Normally, I lean around the midpoint. In other words, if this is a large order, and if this is price directional, and if this is intentional, why would a buyer allow the market to come back below the midpoint? Okay, if it comes back below the midpoint, the order's probably done, and I don't want to be in that trade anymore. Okay, and that's why this trade works very, very well. It's got a tighter stop on around that midpoint, and my target is predetermined. Okay, I'm looking for that extension. I'm looking for, in this instance, it's around a 6-tick target with somewhere around a 4-tick stop. Okay, very, very, very tight, very, very decent strategy. Okay, another example of it, this was today. You can see again, very intentional, very aggressive sell side delta, very high volume. Market comes back into that VWAP, again, goes in and tests in that lower bound, again, comes around that midpoint. This one actually tested the midpoint. So again, not wanting to see too much volume trade around that midpoint. Nice tight stop, but eventually the market went and tested that low tick. Okay, can be applied on 15-minute and 30-minute. I wouldn't do it much above those time frames, simply because when you go beyond 30 minutes, one big order typically will be done within a 30-minute time frame. So be a little bit cautious doing that beyond 30 minutes. And yes, of course, you can apply this to a 5-minute time frame. Okay, I wouldn't go below a 5-minute time frame. You can apply this to a 5-minute, 15-minute, or 30-minute. Go and have a look on your charts. Go and have a look on your footprints. That is the second strategy. Okay. Now, very important. We've been talking a lot about real risk reward today. We've been talking about the pros and cons of, scalping. Let's talk a little bit about risk management. This is where we're going to spend the next, 10 minutes. We're going to talk all about managing a risk when it comes to scalping. Why? The reality is, like I've said to you, when it comes to trading, you don't control targets. Okay, what you do control is your stop management. So you control exactly where you're going to place that stop, and you control the position size. Those are the only 2 factors you control, nothing else. So to optimize and to become optimal as a trader and to make money as a trader, that's where all your time and energy has to go into. You have to become fixated on, how can I use as small a stop as possible, because the smaller stop I can use, the bigger position size I can use. Okay, and if you can use bigger position sizes, ultimately you're going to grow your trading account. Now, can you make okay money scalping? Sure. Okay, you can make 20, 30K a year scalping. You can. Okay, but 20, 30K, it's not worth 11-hour days, 300 days a year, stressing and frustration. It really isn't worth it. Okay, so you can make okay money scalping. But if you want to make scalping or a scalping strategy worth it, you've got to get position sizing optimal. This means you've got to be managing risk. Okay, you've got to have a methodical way ultimately to increasing your position sizes. And then as you gain edge with the strategy, what you can methodically do is increase that position size. Okay, so when you see that real risk reward at 1.25, the next step you take as a trader, as a professional trader, is, how can I now start using bigger position sizes? Okay, most scalpers I've met, they will always stay on 1 and 2 lots. Why? Because that's comfortable, because they don't actually know how risk management works, and they don't have a methodical way to increase that position sizing. Okay, mathematically, if you go do the math, you're going to battle to make any kind of wage or any kind of growth account on 1 and 2 lots. That's just the reality. Like I said, sure, you can make 20, 30K a year. And if that's enough for you, fine. I'm not here to sort of tell you how much money you need to make. But if you want to make real money, you've got to get the position sizing right. You've got to be capable of getting up to 5 lots, of getting up to 10 lots. Okay, that's where you can start to make some really decent money scalping the markets. Okay, now, when I mentor new traders who are scalping, often what I hear is this. They tell me that they don't know how to manage risk. And because they're executing in real time, because they're scalping and, they're very fixated on scalping, they don't have time to manage risk. And I hear that so often. And I cannot be more frustrated by hearing that, because the reality is if you're not managing risk, you will never make any real money. All right. Moreover, if you cannot determine risk before you're executing, you are 100% going to be overtrading the market, and you haven't got a clearly defined rules for scalping. Okay, what do I mean by clearly defined rules? In the previous chart, what you heard me say is very clearly, I'm entering at VWAP, I'm stopping at midpoint, I'm looking for a target at previous highs. Okay, there's no woofy waffy there. There's no interpretation. There's an exact approach to scalping the market. Okay, all I then need to do is go and add on to risk manager, say, I'm going to execute this market. I'm going to use a 4-tick stop. Tell me how much to use, and it will tell you in real time. And I'll show you an example of this in a minute. Okay. If you cannot do that, if you cannot take 3 seconds to go and input that into a system, the reality is you probably don't know your strategy well enough. That's the reality of the situation. Okay. Now, like I said to you, 2 things will typically happen when a trader adopts risk management. So what I've seen, and again, a small sample size, but what I've typically seen is that when a scalper typically adopts risk management, 2 things happen. 1, they start to trade slightly less. And what that means is they're paying away less commissions to their brokerage, but they also tend to have better fills. Why? Because what happens when you slow down just fractionally? I'm not talking about slow down as in 1 minute. It won't take you more than 10 seconds to add a trade onto a risk management system. What happens when you slow down is you start thinking more and observing more. In other words, you have more clarity of thought about where you're getting involved and equally why you're getting involved. All right. Now, as a result of you focusing a little bit better, you'll find you get better entry prices. Okay. You're not going to front run the VWAP. Instead, you'll wait for the VWAP. You're not going to have FOMO and jump in and use a market order. Instead, you'll have a limit order. Okay. What that means, like I said earlier, when you're getting better fills and better entry prices, what that means is you're making a lot more money. Okay. Every tick matters when it comes to scalping. And if every tick matters, you've got to be managing risk. Okay. That is the real key to being successful as a scalper. Okay. Now, finally, the advantage of managing risks means you can actually capture all the data. And I'll show you this in a minute. When you are adding this onto Risk Manager, what it means is when you exit that trade, you're going to get to capture all that data. And this means you can start to determine if you have edge. Okay. So often I see a scalper, I'll say to them, well, tell me how often you trade this trade. Like very frequently, 4 times. Okay. How much money do you make? Oh, no, I make money. Show me something. Show me. I don't capture the data. Why don't you capture the data? Because I do the trade so much that I don't really have time to capture it. The reality is if you're not capturing the data, you've got no way of determining whether or not you're making money. Okay. The danger of a pure scalper, and this is very key, the danger of a pure scalper is that you may be positive in ticks. All right. But over time, what you'll find is that with all that trade activity and all that paying away to your brokerage of the fees, it creates a false illusion of edge. I see this so often with scalpers. They'll tell me they're profitable as a scalper, but their account balance does not reflect it. And that's because of that illusion where you are making ticks, your strategy net grosses ticks, but because you're paying so much to the brokerage and you're being inefficient and suboptimal, effectively, you're not actually making any money. Okay. So just be aware of that. Having data at your disposal is the trade-off you get when you manage risk. Okay. If you're willing to input into a system, 1, you manage your risk, you get to optimize your risk, you have better fills, and you get to capture the data that will enable you to develop that scalping strategy further. Okay. Without it, unfortunately, your upside is capped. And like I said, yes, you can make good money. You can make 20, 30K a year scalping 1 and 2 lots. You definitely can. But again, you have to ask yourself, is that your objective? Is that what you want to achieve with taking all that risk and stress? Now, let's have a look. Let's get on to the demonstration. I'm going to start off actually with the free application. All of you have got access to it. Okay. I'm going to show you on the free application how you can manage your scalping risk. Okay, you can all go do it. There's no excuse. You can capture that data. And then I'll move on to the Tradelo application, show you how to use the scalping grid, show you how with one tick functionality, it takes you about 6 seconds, not even, with about 5 seconds, you can manage risk, capture all that data, and you don't have to think. Okay, now, if you don't have the free SRM Lite application, the link will be available in the description of this video. And obviously, you would have received it in your email when you subscribe to the Tradelo community. Okay, so let's get the free application up. And to start off with, you've all got access to this. I just want to quickly go through the settings. In terms of what I'm using, it's an equal risk weighting. I suggest if you are going to scalp as a strategy, I would use that as the risk strategy. I would set your minimum trade threshold to the number of scalps you typically do on a day. So for this example, I'm going to use 10, and then I'm going to set a daily risk limit of 2.5%. Okay, again, I'm not going to talk about why I've used that. I'm just giving you an idea of what the parameters are for this system. Okay, now, like I said, we're simply going to go onto our risk manager, and to effectively manage risk using the free application, it's as simple as one click. I'm going to add a trade. I'm going to choose my market. Okay. I'm going to scalp the market, and I'm going to tell the market I'm going to use a 6-tick stop. I'm going to click add. And at that point, straight away, I'm optimally managing risk. The system tells me 3 lots. Okay. I'm then going to go onto my price ladders. I'm going to go onto my execution platform, and I'm simply going to execute 3 lots in the S&P 500. Okay. Now note, with the free version, of course, it's not automatically connecting to your front-end application. You'll have to tell it when that trade is live. You're simply going to tell it you bought 3. When you complete the trade, you're going to simply tell it, for this trade, I made $125, and the trade is captured. Okay. There is no excuse to not manage your risk for scalping. It's as simple as 1, 2, scalping, and 4-tick stop, and straight away 5 lots. Thank you. I'm going to execute the 5 lots. I'm going to sell the 5 lots. I'm then going to simply go and tell the system I lost $35, and it's captured. Okay. With that, you're capturing all of your data. You're managing your risk. You're thinking a lot more, and you can actually go and look whether or not you've got edge trading your scalping strategy. Okay. That's how we do it in the free application. Let's go have a look how we do it then in the main Tradelo application. For this, I'm also going to get up some price ladders just to show you the automatic connectivity. For this, obviously keep in mind, this is all a demonstration. Nothing you see as real. So don't worry if I make thousands of dollars. It's not real. So let's have a look at the automatic version. Keep in mind, this is all connected. Okay, so my trading ladders are connected to my front-end platform. But what you have in the Tradelo application is you've got the scalping grid. It's this little icon here. So we're going to click on it, and I'm going to show you how it works. Okay, so rather than you adding a trade, selecting which market you want to trade and all that, it's as simple as one-click functionality. Let me show you how it works. Okay, I'm going to go in the ES 500. S&P 500, and I'm going to go on my scalping strategy, and I'm going to simply click once. Okay, at that point, it's going to tell me that I need to go and use 6 lots, and I'm simply going to go buy the market, and everything then updates in real time. Now, at this point, I'm objectively watching the markets. Okay, I don't need to click anywhere. I don't need to do anything else. I can put my stop in, I can go put my target in, and I can simply just scalp the markets. Whoop, wrong button. Okay, I'm simply going to scalp the markets, and then I can leave the trade. Okay, if I want to go and scalp the gold at the same time, I can go click one-click functionality. I can go into my gold. It says I need to sell 10 lots. So I can simply go sell the 10 lots, and I can simply go put my stop in and scalp the markets. Okay, I'm now scalping the markets. I don't need to do anything else at this point. I can simply just watch and observe what's going on with my scalps. Everything's now managed. Okay, my risk is taken care of. Once these trades fill, whether they fill for profit or whether they fill for loss, I'll just show you that just to illustrate it for you. Okay, we're just going to bring that down a little bit, see if we can create a little bit of activity. So the gold is now being stopped out straight away. Gold captures all the data. I don't have to do anything. If I want to execute the gold again, I simply click one-tick functionality. I can again go and scalp the gold, 10 lots in, place my stop, and continue to do my trading. Okay, it's one-tick scalping functionality. In other words, you can see it takes me all of 1 second to click on the mouse. It tells me exactly how many lots to use, 16 lots or 6 lots to use or 10 lots to use. I don't have to think. Everything is automatically managed for me from that standpoint. Okay, and this is the key to scalping. You want to scalp, you want to make money, you've got to be able to increase that position size automatically over time, but equally you want to be capturing that data.